Here we go. Photo right here. Here it is. Monetary McFly from Monetary Guy 589. Last week, the Federal Reserve paid approximately $2.875 billion in interest payments to commercial banks on their reserve balances. 40% of this went to foreign banks. All right, well, I have the analysis. Now, hopefully, all of us here in the Americas don't get so fucking revolutionary and fucking crazy over this. So let's actually find out what's really going on. Okay. Today, the Fed now pays banks 4.40% on the money. Reserve balances they keep parked at any of the 12 reserve banks. Banks are holding a little over $3.23 trillion in those reserve accounts. Multiply that and you get roughly $2.5 to $2.9 billion every week in interest. So roughly 40% of the checks, about $1.1 billion last week, go to the U.S. branches of foreign headquarters banks because they hold about the same share of reserve. Now, there is a real explanation on why. That's always the question, why? So the Fed began paying interest on reserves in October 2008 so it could flood the system with liquidity during and after the financial crisis. But yet, they still keep the Fed funds rate within its target range. Now, the earned interest on the reserve has since become the floor for money market rates. When the FOMC adjusts policy, it simply moves how much that rate will be, up or down. High policy at 4.4%, and today's 4 bips higher than it was in early 2022. However, it is still a large balance sheet. Even after 2 years of quantitative tightening, the reserve balances are north of $3 trillion, far above the 2008 norm of $100 billion. There's no offsetting income as well. The Fed's portfolio is stuffed with older treasuries and mortgage-backed securities that yield 2%. With the rate compared to the current asset yield, the Fed has been running operating losses and has stopped sending surplus earning to the treasuries, booking a deferred asset instead. Now, this is the trickery on the book of the government because some of the debt of the government is owed to the people and or to the government, so they can play around with it. That's a topic for another time, but that's something they can do. So, branches of foreign banks operating in the U.S. are big reserve holders for 3 structural reasons. Branches that are not FDIC insured, so they avoid paying deposit insurance fees. Now, these are foreign institutions who aren't paying it. They're not like U.S. banks like Chase or U.S. Bank or Logix or any of the other beautiful ones, okay? Meaning holding reserves is a cheap and risk-free way of holding funds. Now, the liquidity coverage ratio, high liquidity assets,